Will owning an LLC trigger an audit? Yes, if you are committing these 7 deadly tax sins. And yes, business owners, side hustlers, influencers, people that operate a business, IRS is coming for you. Why do I say that? Because IRS is looking to close the tax gap and generate more money for the government. I want you to like, comment, and subscribe, and I want you to hang on until the end so that I can show you exactly how to obtain all the information IRS has on you in the event of an audit. Here's the thing, IRS is looking to get more revenue, and the way that they get revenue is they audit taxpayers to generate revenue for the government. IRS is certain that small to mid-sized business owners are the biggest opportunity to be able to audit and secure more money. That is why these 7 deadly tax sins have to absolutely be avoided to ensure that you're not audited. Number 1 is using round numbers. Many of you are using rounded numbers as tax deductions. Let me give you an example. When I ask a client, how much did you spend for your cell phone? They'll tell me $1,200. How much did you spend on your office expense? They'll say $500. We as tax people know that deductions are not rounded. Typically, our expenses are going to be $501, $1,032. They're not going to be rounded numbers. But when IRS sees rounded numbers, that's a red flag for IRS to audit your return. So do not use rounded numbers unless your actual expenses total to rounded numbers. And if you are using guesstimates, I advise that you always round off your guesstimate and use a different number at the end. I recommend using your actual expenses and tracking things properly, but if you have to guess at it, don't end it with a 0, don't end it with a 5, because IRS is definitely on to that strategy that taxpayers currently use. Number 2, underreporting your income. So many of you are underreporting your income. How does that happen? Number 1, many of you think because you didn't receive a 1099 from someone that they didn't report that income that they paid you. Many businesses will send a 1099 directly to IRS and they will not necessarily send it to you. So you got to be very careful. The other way IRS knows that you're unreporting income, because people may be paying you by check and you're taking that check to the bank and you are depositing a portion of it and you are lessing back cash. For example, you may have a check that is $2,500. You go into your bank and you less back cash of $1,500 and only $1,000 gets deposited into your bank account. But in the event of an audit, IRS is going to request all of the records that were deposited in cash against your account. The moral of the story is report all of your income so that you do not inadvertently trigger an audit. Number 3, using your personal vehicle as a business write-off. This is an area that IRS is really going after because they know that most business owners are allocating 100% of their vehicle expenses against their business, and IRS does not like that. If you have a personal vehicle that you are utilizing, make certain that you're using a standard mileage rate and make certain you're allocating a portion of that mileage toward personal expenses and that you're documented properly so that you can avoid an audit. Number 4, commingling funds. What does commingling funds mean? That means that you're using your personal account for business expenses and everything is mumbo jumbo. Do not commingle funds when you are dealing with the IRS. You want to be crystal clear on what's a personal expense and what is a business expense, which is why I always recommend that you operate your business out of a separate account. It may even be a separate personal account, but every business expense needs to go through that account and all business income needs to go inside of that account, because commingling funds is a nightmare when it comes to an audit, and you definitely want to avoid that. Number 5, excessive business losses. If you are losing money year over year, IRS has the right to come in and audit you and reclassify your business from a business to a hobby. And when they do that, they're going to disallow all of your business losses. So you want to be very careful to make sure that you're not taking business losses every single year. And if you truly are losing money, every year the loss should become less and less. So in year 1, if you lost 10,000, in year 2, it should be 10,000 or less. In year 3, it should be less than that. Make sure you're showing IRS that your business is gradually improving. Number 6, failing to file your LLC tax return. This is a big one, and I hear this often in practice where clients are not filing their LLC tax return because many of you are thinking, I didn't make any income, there was no activity, I don't need to file that return. Once you create an LLC, you have to file a tax return every single year, whether there was any activity or not. It's called filing a zero return. You still have a filing requirement. And when you don't meet that filing requirement, IRS then flags you for an audit. So make certain you are filing your income tax return every single year for your LLC, regardless of whether or not you had activity, regardless of whether or not you made profit or took a loss. Many of you think you don't need to file if you have a loss, but you have to file every single year. And number 7, big fluctuations in income and expenses. Many taxpayers are going from making a small amount of revenue to a large amount of revenue. Or they go from having a small amount of expenses to a large amount of expenses. And it's okay if this is legitimate, but remember, IRS is looking for variations in your tax return year over year. So if you go 1 year from making a small amount of money, then all of a sudden you're making a large amount of money, you are flagging your return for audit. Now, I don't want you to think that every single audit is bad. Yes, it's an inconvenience, but if you are truly increasing your revenue, you have to report the correct amount of revenue. The takeaway is making sure that your books and records are very tight, making sure that all of your expenses are documented properly. So in the event that you flag an audit, that there is not going to be any issues with your tax return. It's really important that you understand that. And here's the thing. I told you that if you stayed to the end, that I was going to tell you how to get all the information IRS has on you in the event that there is an audit. The first thing I want you to do is to go to irs.gov and create an account for yourself where you can log into the IRS system and you can pull down all the income people reported on you, all the other information IRS has on you. You can get out of your irs.gov account. But here's an additional secret. You can always create a Freedom of Information Act request. FOIA, F-O-I-A. A Freedom of Information Act request is where you write a letter under the Freedom of Information Act requesting IRS provide you with all documentation they have on your file, including their notes, including their internal memos, including everything they have in their records that you normally would not be privy to. And that is a very powerful tool when you're in an audit with the IRS. You want to know exactly what they know about you. And that is definitely something that you want to do. And so now that you know the 7 deadly sins that can trigger an audit, which are using round numbers, underreporting your income, commingling funds, big fluctuations in income, taking your car write-offs when you're using your car for personal expenses versus business expenses, when you fail to file your tax returns every single year, year after year. When you know better, you absolutely have to do better. That is why I want you to like, comment, and subscribe so I can keep you updated on all things tax.